We believe if the earnings growth are stronger, then the market will continue to do well and vice versa. Our focus as a house is only and only to predict earnings growth. We continue to only focus on one item, which is earnings growth, right? If you look at one slide, I think the thing that government has really done very well is if you look at in 2000 to 2008, government focused massively on the capex side. So gross fixed capital formation as a percent of GDP went from 28% to 35% of GDP. In the last 10 years, from 8 to 2020, we saw massive deceleration of capital goods cycles, right? So we went back to 28, 29%. Now we're moving up back again to, we are almost right now at 30 to 33%, right, in terms of capex. But at the other side, the consumption has started to come off because of inflation that we are seeing in the economy. We are seeing meaningful reduction on the consumption side. So addition of consumption and gross fixed capital formation has to become 100, right? So we are seeing some weakness on the consumption side, which is clearly impacting the consumption part of the market. On the fiscal side, I think government has done a phenomenal job on fiscal deficit. We have seen probably after the pain of COVID, we went fiscal deficit went to 9.2%. We're now down to 4.9. We believe we should be touching closer to below 4% by next year. And tax buoyancy has been quite strong as well. If you look at debt to equity of corporate India, is actually lowest in 15 years. If you take away just Adani, it'll be maybe lowest in 30 years. ROE of the corporate India is actually at about 15-16%, which is again quite healthy. Corporate profit to GDP again back to 6.3, 6.4%, which is again quite strong. Forex reserves continues to be very, very strong, a sign that a country is doing very well. Because when a country does very well, everyone wants to invest in a country. You get more FDI, more FI flows. You've seen that clearly playing out. And right now, our forex reserve is northwards of $650 billion. Moving to valuation, obviously valuations have been the topic of most discussion. Yes, it is expensive than the longer term averages, but it's also expensive because the growth that we are generally used to, which is 4-5%, is now gone to 35-40%. So when you have earnings growth of more than 30% or 35%, then you will see valuation uptick happening. And if you see earnings growth reducing to say 5 or 6%, you will see stock correcting and valuation also compressing. We believe India is on a 10-year uptrend with a near-term consolidation phase. But if you take a 5-year view, then I think we clearly see earnings acceleration to continue from a 5-year standpoint. Near-term can be challenging, but I think one really needs to take a slightly longer-term view. So we do believe that the valuation are expensive, but now we are seeing some corrections in the valuation also because the market has come off by more than 10% from the top. And we are seeing some signs of valuation becoming much more reasonable. So this is the most important slide. What are the themes that we like in the last 4 or 5 years? Some of these themes we have played out, some of the themes we don't have anymore, but I just want to put across all the themes that we did in the last 4 years. First is hospitals and diagnostics. We don't own any diagnostic anymore, but hospitals and diagnostic, we were the biggest beneficiary of the cycle. Then it's financialization of savings, which is capital market companies, high growth NBFCs. Then we have the new tech food delivery businesses like Zomato, where we were the first one in India to buy in a big way. Right at the bottom of the chart, Policy Bazaar, all of them. Then China Plus One, where we had chemicals. Now we don't own chemical stocks, but we had chemicals in the past. Electronic manufacturing services, textiles and garmenting, all of them have done extremely well. Make in India, where we are seeing capital goods, infra, renewable sector doing extremely well. Within urbanization, leisure and luxury, travel and hospitality, premiumization trend, jewelry, all of them have done extremely well for us. And last but not the least is telecom, which last year we became quite aggressive as we believe that the country will see meaningful acceleration on tariffs on a year-on-year basis. So that's broadly, I think, the slides that I thought I'll share it with you. These are the things that we continue to like. At this point in time, we are overweight on IT, pharma, manufacturing, telecom, and consumer discretionary. We are underweight on banks, underweight on metals, underweight on oil and gas, and underweight on PSUs. So these are spaces where we have generally underweight, and which has done quite well for us. The strategy and calls that we've taken has done extremely well for us for this year. So maybe I'll stop there, and kind of happy to take questions with most of you.
All right. So I believe a mota line of understanding what Niket has been demonstrated here. Let's have the better communication and the conversation with Niket. So we can start with the Q&A, and anyone who would like to ask a question, Niket is here, and we can really start the same. Thank you.
Good afternoon, Niket ji. This is Vivek.
Hi.
A quick question. When you are saying you are underweight on banking, does it include NBFCs as well?
Yes, overall banking and financial space put together, we are underweight. NBFCs, we are overweight. Banks, we are underweight. Because what happens is, Vivek ji, if you look at the interest rate cycle, most of the banks run a fixed price book. They don't run a variable price book. And they typically borrow from banks, they borrow from CP market. So bank is obviously the largest borrowing for NBFC. So if the interest rate cycle comes down, then the bank's interest rate that they lend to the NBFC also starts coming down. So the cost of fund reduces for the NBFCs. But the NBFCs typically have a fixed price book. When they lend to fixed price book, right? Most of their lending is at a fixed price for 5 year, 6 year period. In that case, they see NIM expansion. So when interest rate cycle goes down, NBFCs benefit, but banks don't benefit. And hence we are overweight by NBFCs and underweight banks.
Sure. But there are NBFCs which is basically like Geo Financial,
Yes.
PFHL or something. They are kind of pulling funds. So there is no dependency as such on the bank's fixed rate, right? So that's what my understanding says. But if there is any, so possibly the bullishness may come from there, or there are some other triggers as well.
Yeah, so I think if you look at Geo Financial, obviously is a company owned by Reliance. They're the first one to go to do a DTC lending, where D2C lending, where basically they will not have any middlemen. Everything will be done digitally, which is one of its kind of a thing in the NBFC space. We have started to see some scale up of their business because they've launched all the product last quarter. We will see this quarter as a full ramp up of their businesses from a AUM growth standpoint, and we believe in the next 2 to 3 years we will see that getting created more and more as we kind of move forward. So I think they're early days. The good thing about Geo Financial is they are very well capitalized. They have 25,000 crores of cash on balance sheet, and if they're able to grow this in a meaningful fashion, by leveraging about 4 times, they should do a 1 lakh crore AUM in the next 3 to 4 year period with reasonable amount of ROA. So we believe that they are in a very sweet spot, very strong brand equity, and their customer acquisition cost will be far more lower because of the strong brand that they have. Their access to liquidity, their access to liability will be again quite cheaper. So we do believe if you take a 2 to 3 year view, they will do materially better from current levels.
Thank you, sir. Thank you very much.
सर ये स्मॉल फाइनेंस बैंक का क्या पोजीशन रहेगा?
So स्मॉल फाइनेंस बैंक में 2 challenges है. स्मॉल फाइनेंस बैंक टिपिकली उनकी कॉस्ट ऑफ फंड ज्यादा होती है. जैसे आप एयू स्मॉल फाइनेंस बैंक देखोगे तो उनकी कॉस्ट ऑफ फंड काफी ज्यादा होती है. जब आपकी कॉस्ट ऑफ फंड ही ज्यादा है और अगर आपको 4 से 5% का निम कमाना है तो आपको लेंडिंग भी थोड़ी आई वुड से हायर यील्ड पे करनी पड़ती है. जो कस्टमर आपके पास होते हैं वो टिपिकली नॉन बैंकिंग कस्टमर होते हैं, जो एक एनबीएफसी और बैंक्स के बीच का जो कैटेगरी है वहां के कस्टमर होते हैं. तो कहीं ना कहीं स्मॉल फाइनेंस बैंक में एक अपॉर्चुनिटी ये है कि जो एग्जिस्टिंग स्मॉल फाइनेंस बैंक जैसे एयू हो गया और एग्जिस्टिंग दूसरे 1-2 जो लिस्टेड वाले हैं, कहीं ना कहीं वो 5 साल खत्म होने के बाद उनको यूनिवर्सल लाइसेंस के लिए एप्लीकेबल हो जाते हैं. अगर उनको यूनिवर्सल लाइसेंस का अपॉर्चुनिटी मिलता है तो उनका कॉस्ट ऑफ फंड भी ओवर अ पीरियड ऑफ टाइम कम होगा, एंड दोज बैंक्स आल्सो विल कंटिन्यू टू डू वेल. So I would say longer term, quite positive on some of the selective small finance bank, but near term there will be challenges on NIMs and asset quality as well for some of these players.
Thank you, sir.
And sir, what's your view on niche themes such as drones or hydrogen combustion engines and maybe space kind of players which possibly may come up. Is there any view that you guys have formed, or you have formed, or any?
Yeah, so I think some of the drones businesses that we know, see, drone business is a business where the size of opportunity in India is not very large, because a large part of the buyer is only government of India. I know a lot of companies on the unlisted side talks about we do drones for agriculture. I don't think there is unit economics in doing drones for agriculture space. If their companies are showing profitability, I'm not very sure whether the books are correct or no. But when we did a deep dive on drones category, we do believe it's a very lumpy business with a large government or being an order inflow, because largely defense drones and all, where there is reasonable amount of profitability there. Most of the other categories, it's quite difficult to get to see meaningful acceleration in drone penetration. Drones are not used by you and me as a customer. Drone will always be used by the government of India for surveillance of their borders or for any other missile activity as such. So I think drones is a category I would generally love to avoid. Same as with hydrogen. I think very early days in the technological area, which technology will do very well on hydrogen. It's yet to be proven. Unit economics are still not there on hydrogen. So I think India's hydrogen at scale, if all, will only happen post 2030. I don't see any meaningful acceleration on the hydrogen side at this point in time. I've just generally seen a L&T hydrogen plant, and I've realized that even they are basically putting a pilot plant and seeing how this will really shape up. So still long way to go on space, hydrogen, all of them. We still quite long way to go. Even on semiconductors, quite long way to go. Not there yet.
Okay. Sure. Thanks.
A question here that how does the IT looks from here?
So IT has meaningful advantage because Donald Trump has clearly said that he wants to cut interest rates, and he also wants to cut tax rates for US enterprises. Whenever there's a tax cut for US enterprises, we do see IT doing very well because US companies will have more cash flow in their balance sheet, and hence they will be willing to spend more on IT. So I believe that IT will be in a very good position, at least for the next 1 year standpoint.
Okay. Niket, one more question which I have, the other people will not ask, certainly into the chat box, is last 3 years, the entire value has been run up like anything. Prior to that, the entire quality has been run up like anything. Do you see that again the quality is coming into the game back,
Yes.
and again quality will come to play? Can
Yeah,
you just throw some light on this?
So I think when value was doing quite well, companies with high growth were still doing well. So we did well even when value was doing well, right? One thing which I've generally seen, growth does well across cycles, provided you buy it at the right time. So we've done quite well when value did well. I think what is important to understand is when the earnings growth of the economy slows down, only quality companies tend to see strong earnings growth, right? So we have seen in the past, in 2008 to 2020, earnings growth of the economy was 5-6%. And if you compare that with earnings growth of high quality companies like say HDFC Bank and all of them, was 20%. So the high quality ones will grow at a faster rate in an environment of slowdown. And that is where I think quality really makes a big comeback. And the non-quality will any which ways die down, or we'll see meaningful earnings correction or earnings downgrade because it's more cyclical in nature. Right. So that's why I think quality is making a big comeback this year, and I think this will continue into next year as well.
So quality is the theme which will be probably working well.
Absolutely.
And I believe your portfolio also will go to add a lot of quality stocks at that.
Correct.
Right?
Correct.
Another question, Niket, is one very important aspect. How much earnings you are looking for next 5 years perspective, or let's say by 2028 or by 2030, how the average earnings you are looking for?
Yes. So I think an average earnings expectation on Nifty is broadly about 13 to 14% from a 5-year CAGR standpoint. For mid cap is about 16 to 18% for next 5-year basis. And small cap will be,
which is already overvalued.
Yeah. So similar range of 16 to 18% earnings growth. So earnings growth will be in that range.
Overvalued, still you expect that 16 to 18% earning growth will be there?
Yes.
The 45% to the premium पे खड़े हैं हम लोग.
प्रीमियम पे है तो वैल्यूएशन है, earnings growth तो एक data point है, right? Earnings growth is
Okay.
Any which way. See, earnings growth has nothing to do with what premium it trades at. Premium can go to 100% also tomorrow.
Okay.
But I think when we're looking at earnings growth, I think broadly we're looking at about 13 to 15% for Nifty companies,
Okay.
large cap, and
Okay.
mid cap of about 16 to 8, closer to I would say 18% for mid and
And
small.
your sweet baby of micro cap.
Yeah. So micro cap maybe even slightly higher, maybe close to 20%. But in large cap
20%.
space, what I
Uh-huh.
also want to highlight is that the next 6 months can be, low single digit for large caps and
Okay.
for
Okay.
mid caps also. But
But that is where actually the time of investing. Is that mean?
exactly. So that's what I was coming to. So the next 6 months are probably the best time to invest because the market is in a consolidation phase. People would have given up. Everyone would have said that market was overvalued, kuch nahi hoga. So that is the best time to invest. And market is down by almost 15-20% from the peak. Stocks are down 30% from the peak. This is probably the best time to invest. So that after 6 months, when the cycle starts again, the bull market starts again, we will be in a very good position.
Super good. Just one more question which I have is micro cap is into the premium or it is into the consolidation or just
I would say more of a consolidation phase at this point.
and premium कितना रहेगा आज का?
Or premium would be at least 30% higher.
It's 30% higher. Okay.
Mid cap is about 15% 1 year forward. Small cap is about again 16-17%, and micro cap would be about slightly about 25 to 30% in that range.
Okay, and that's something really great. Okay, good. Do we have little more questions? हमारे पास और questions है?
Yeah, from
Yeah,
a
please.
consumption perspective, Aniket ji, what's the view? Because I'm getting the vibes consumption is expected to pick up because it has slowed down in last couple of quarters. As per my reading, maybe I could be wrong, but is this because government most likely is going to come up with a budget, and what are your expectations from the government budget as well as how you see the consumption is going to play?
Yeah, so I think consumption, the way it is stuck up is that if you look at consumption has two cuts. One is discretionary consumption, and the second part is I would say FMCG. FMCG is still struggling. There's no signs of recovery at all. This consumer discretionary is still seeing some signs of green shoots at the margin, which is obviously going to benefit some of the consumer discretionary companies, and that's why we are overweight on consumer discretionary and not on FMCG. The reason why FMCG is not doing well is because of significant inflation in the system. When there's massive inflation, people don't have money to at least have reasonable amount of food, and hence I think getting into any premiumization trend from an FMCG standpoint becomes quite difficult. In the past, we have seen when consumption or inflation is quite low, consumers' incomes are high, they tend to do premiumization. So we haven't seen that so far, and I don't think we will see that. With the so many, we have seen massive amount of freebies given by a lot of state government. All that freebies have gone towards food inflation, because the first time anyone who gets money decides to have a good food, not even good clothes or good shelter, but good food. So that drives food inflation higher. Because of higher food inflation, and you are seeing some impact on the consumption side at this point in time. So we are not seeing, and also the government spending on rural is quite weak. Government has not added any meaningful expenditure to rural India. So whatever has been the Manrega spend has been broadly similar. There's not been any meaningful addition to that as well. So from that standpoint, I would say clearly consumption on the FMCG side will remain weaker, and we will see some good signs. I think on the consumption side, on the consumer discretionary, which is more luxury, the top 1-2% of the India's population.
Okay. निर्मला जी से क्या उम्मीदें हैं आपको, मतलब अभी what do you expect?
I think they should do tax cut. I think given the inflation pressure that we are seeing, I think you will see meaningful amount of tax announcements and tax changes, specifically on the business side. Because when there is business income to a lot of people, they take a lot of other exemptions. And I think government do believe there's a loophole there, which I believe they should address. And they will cut away that loophole. So for example, if you're running a business, you're a lawyer or a doctor, you have certain income and you show certain expenditure and you get that benefit. Those benefits, in my opinion, will be taken away. So that's a hit. That's a gain to the government because I don't give you that benefit anymore. On the other side, they will pass on that benefit to lower the taxes as far as slabs are concerned. So my expectation is this government has to reduce personal income tax rate meaningfully to revive the animal spirits in the economy.
Yeah. Or just one last quick, since you talked about premiumization, you expect that to play out maybe in 2 years in the car segment, just like landmark cars, etc., etc.
I think you will see a slow and gradual shift over the next 5 years towards luxury. Luxury is still growing at faster pace than the economy. And as a country does very well, we've seen that with Japan and China, luxury comes back with a big bang. Luxury is generally much more stable because the rich guy really doesn't get impacted in any cycle, right? If you're 1,000 crore worth person, if markets go down by 30%, still 700 crores, you can afford anything. So the top 1 or 2% strata generally is a little more stable, and a lot of people keep getting added to the luxury category. There are a lot of aspirations that people have for brands. So I would believe that that part of the story will continue to do quite well.
Thank you.
Thank you. Yeah, do we have some more questions? Already consumption and I believe pharma you already spoke on, right?
Yeah.
So I believe if we are not having more questions, then can we go for a thank you? Vote of thanks. All right, thank you. I request Priya to give the formal vote of thanks.
On behalf of everyone here, I would extend our heartfelt thanks to Mr. Aniket Shah sir for this insightful session on the market outlook. Your expertise and clear explanation of complex trade have given us a deeper understanding of where the market is heading and how we can navigate it effectively. Your practical advice and forward-looking perspective are invaluable, especially in these dynamic days. We truly appreciate the time and effort you took to prepare and deliver this session. Thank you, sir, once again for sharing your knowledge and guiding us. Thank you very much, sir.
Thank you.
Thank you very much, Niket. I know that your time is really precious and you really spared your time with us. Thank you very much.
No, thank you, Deep. Thank you so much.
And thank you very much, everyone, that you really spare the time in the schedule of the 5 o'clock is something really, really difficult. But yes, thank you very much, everyone. Thanks a lot.